It's interesting. I'm looking, we're talking about an overall pullback, but Shopify is still up around 15% for the year. Affirm is about even from where it first started trading. But yeah, as I mentioned, PayPal and Square down a bit. Is this a valuation reset or something more concerning?
Well, look, I think this is very straightforward. When you raise interest rates, or when there's an expectation of raising interest rates, your discounted cash flows are going to change. You're just dividing by a higher number. So tech companies tend to produce a lot of cash flow in the outer years, 5, 10, 15, 20 years in the future. And if you divide by a non-trivial number, the valuations are just going to change. It has nothing to do with the performance of these companies, as far as I can tell. It's just a simple discounted cash flow analysis. And basically, nobody was discounting the present value by any meaningful number until inflation started kicking in. It was obvious to everybody, which means interest rates must go up.
But it certainly seems to be impacting some stocks more than others. I mentioned Shopify still up about 15% for the year. I think that's also true of Adobe, even after the pullback after its earnings. Both of those have some play in e-commerce, Shopify especially. But there's also a broader idea that they're changing the game. Though I guess you could say that about a lot of these companies. What do you think accounts for the difference in the degree of these pullbacks?
Well, some of it's just cash flow expectations, like how far out are the cash flows that are material, whether they're 3 years, like let's say Adobe, for example, probably sooner rather than later. Some are further out in the future, more high growth, very high tech companies where a lot of the profits are 5, 10, 15, 20 years into the future. So that may account for some. Obviously, there's micro performance. There clearly are some stocks, some companies, some equities that are going to outperform others, that better management teams, better potential in the market. But if you look at the effects, some of the best run companies that I'm familiar with, DoorDash, has been significantly affected. Square has been significantly affected. So I don't know, exactly what's driving the alpha versus the beta. But I think if you just did the discounted cash flow analysis per company, you could get to 80% of the right answer.
Keith, you mentioned Shopify. I want to get you to tell us a little bit about your new roll-up of Shopify merchants. OpenStore just hit a $750 million valuation. What's the opportunity that you see there over the long term, and how is this different from what we're seeing in the roll-ups of Amazon merchants with companies such as Thrasio?
Sure. So absolutely. If you take a step back over the last decade, the most impressive tech story, other than maybe SpaceX, is Shopify. Out of nowhere, Shopify has constructed a $150 to $180 billion company right down the middle of the sweet spot of Amazon. So basically portraying this myth that Amazon has all this pseudo-monopoly power that all these politicians talk about. Shopify has created a direct competitor over the last decade that's doing better than Amazon. So the biggest trend is building a new, vibrant entrepreneurial endeavor through creating a Shopify store. So when I looked at that, I said, wow, okay, great. There's this macro trend of everybody starting a business on Shopify. Well, guess what? Only a small fraction of those businesses are going to be explosive enough for venture capital, like my day job. 1 out of every 100, 1 out of every 1,000 maybe. In fact, there's 2 or 3 public companies that were built off of Shopify. But the average entrepreneur that starts a business on Shopify sells less than $10 million of sales. It isn't exploding, and they don't really have access to debt. So that those entrepreneurs have 2 choices. They can run the business forever, decades, or they have, sort of no option for liquidity. And I said, well, guess what? We're going to create options for liquidity. So we're going to instantly underwrite these businesses using just data, same day, give people an offer. And whenever they decide, the entrepreneur, the proprietor, the founder decides that he or she no longer wants to run the business, we'll give them liquidity and buy them out. And so that encourages more people to start businesses on Shopify because they now know there's light at the end of the tunnel. They don't have to wait for some generational transfer, like, their son or daughter taking over the business, or they don't have to commit the rest of their lives to something. So that's the most important thing. Compared to Amazon startups, Amazon roll-up startups, and there's like 13, 14, or 15 of them all trying to do financial engineering. It's basically new age private equity. Basically, we're going to buy low EBITDA, and sell high. With the market being at its height 6 months ago, there was an arbitrage opportunity between EBITDA that they can acquire businesses on Amazon and what they hope to trade at. I think that arbitrage opportunity has been materially compressed.